The International Energy Agency has lifted its oil demand growth forecast for this year and next, thanks to surprisingly strong demand from China and the U.S. IEA also noting that concerns around supply in the Middle East have eased, despite ongoing conflict in the region, though noting that the situation could quickly change. Oil prices have retreated from the near record highs in early October, fueled by concerns in the Middle East. The lift coming just a day after OPEC raised its 2023 growth forecast, though it left its 2024 forecast unchanged. With more, we want to bring in Vikas Dwivedi. He's a global energy strategist with Macquarie. It's great to see you here, Vikas. Thanks so much for joining us on our new set in studio. So let's talk about what's ahead for the oil market, because I think there's lots of questions just exactly what prices are going to look like going forward. And you take a look at where things are today, much lower. We have oil just below $80 a barrel, much lower than maybe we had braced ourselves for, given the conflict that started just over a month ago. So what does this tell us then about the prices between now and year end?
Yeah, what we think it tells us is that this market is not as excited about paying for conflict and the potential supply disruptions that come with wars and other types of disruptions, because over the past several episodes of big breakout issues, supply has not been disrupted. So I think that's why we saw a very limited response once the Middle East tensions really broke out, and then it didn't even keep that limited response. It kind of gave it all back and then some. Right. The market is also grappling with how much OPEC production and how much OPEC supply is actually making it out to the marketplace. The cuts were real. I think they still are real, but there seems to be slippage, and there seems to be more oil in the market than the cuts would have implied.
To what extent are you anticipating that the supply issues would continue to be a headwind risk for inflation as well?
Yeah, it's a risk, but we have been on the view that oil supply is plentiful. The underinvestment thesis that so many have been thinking is the state of affairs, we have disagreed with that. We think the market has invested enough in oil supply, and supply can respond to prices. So we don't believe oil will be a big factor in inflation. You know, it is a factor. It never won't be, but
not an outsized.
Not an outsized factor. Yes, exactly.
So what does that then mean for gas prices? Because we certainly have seen, obviously, as the price of crude has come down, we've also seen some relief at the pump, off just about 30 cents, I believe, in the past month alone. Is that steady decline? Can we expect that to continue given the movement that we've seen in crude?
We think so, yeah. And typically it takes a while for retail gasoline to come down with wholesale prices. So there's still that lagging effect that will probably show up at the pump over the next few months. You know, unless oil prices really take off again, obviously that is a risk always. But if that doesn't happen, and we don't expect that to happen, we think the pump price will keep falling.
We've seen a fair bit of consolidation over the course of this year in the sector. What does that kind of, and how does that play into some of your own projections for the supply side as well going forward?
Yeah, it's a great question. As consolidation occurs, we think initially it may slow down supply growth, but over time it will actually help supply growth, because you'll just be in a situation where more acreage and more drilling is in the hands of better capitalized companies, and they can grow off of a bigger base effectively.
Will we see more consolidation, do you think, within the sector?
Yeah, we believe so, yeah.
And when we talk about what those deals would potentially look like when some of these oil giants are out there evaluating what the best option is now, can you give us any insight in terms of, we've obviously seen Exxon doubling down on fossil fuel, just one of the examples, Chevron obviously as well, and then trying to balance that with this transition that we've been talking about to clean energy. How are they thinking about that?
Yeah, it looks to us like they are approaching it in a sensible manner. And what that means is, you know, you have to stay in your core business and stay good at that, because the world still needs tremendous amounts of hydrocarbons while we move to a cleaner energy world. And so you do both. And, you know, we think that is what defines transition versus cutting away to something more dramatic and drastic before the technology is ready and before the grids are ready, things like that. So, we think they're balancing both initiatives.
Excellent insight and analysis. Vikas Dwivedi, who is the Global Energy Strategist over at Macquarie Group. Thank you so much for taking the time.
Thank you,
in
guys.
studio.
Thank you.
Absolutely.